If you're 65 or older, your tax return changed in 3 separate ways, and most people only know about one of them. There's the standard deduction everybody gets. There's an extra amount just for being 65. And then there's a third one, brand new, worth $6,000 per person, that did not exist before 2025 and is scheduled to disappear after 2028. That third one is the reason I am making this video. It is not a loophole, and it is not a secret. It is written into the tax code. The IRS publishes a leaflet about it, and you can claim it whether you itemize or not, which is unusual. But it is new enough that a great many people who qualify have simply never heard of it. So in the next 10 minutes, I will show you what all 3 of these are, how they stack on top of each other, exactly who qualifies for the new one, and the income level where it starts to shrink. I will also explain something important that a lot of videos get wrong, which is what a deduction actually does to your tax bill. Because it is not the same as money in your pocket, and I want you to understand the difference before you plan around it. Let me start with the one everybody knows, because the other 2 build on top of it. The standard deduction is a flat amount the IRS lets you subtract from your income before it works out what you owe. You do not have to prove anything or keep any receipts. You just take it. For tax year 2026, the year you will file in early 2027, that base amount is $16,100 if you file single and $32,200 if you are married filing jointly. If you file as head of household, it is $24,150. Those are the starting numbers. Everyone in that filing status gets them, whatever their age. Now the second one, and this is where age starts to matter. On top of that base amount, if you are 65 or older, you get an additional standard deduction. For 2026, that extra amount is $2,050 if you file single. If you are married, it is $1,650 for each spouse who is 65 or older. So if you are both over 65, that is $3,300 added on. And here is a small detail that catches people out every year. The IRS treats you as 65 on the day before your 65th birthday. So if your birthday falls on the 1st of January, you count as 65 for the previous tax year. There's also a separate additional amount if you are legally blind, and you can claim both if both apply to you. And now the third one, which is the reason most of you are here. Starting with tax year 2025 and running through 2028, anyone aged 65 or older can claim an additional deduction of $6,000. For a married couple where both of you are 65 or older, that is $12,000. This came in with the tax legislation signed in July 2025, and it is genuinely additional. It sits on top of the base standard deduction and on top of the age addition I just described. What makes this one unusual is that you can claim it whether you take the standard deduction or you itemize. Almost nothing in the tax code works that way. Normally, you choose one path or the other. This deduction does not care what you picked. So let us put the 3 together, because stacked up they come to a number that surprises people. Take a single filer aged 67. $16,100 of base standard deduction. $2,050 for being over 65. $6,000 from the new senior deduction. That comes to $24,150 of income that is simply not taxed. For a married couple where both are over 65, the same arithmetic gives you $32,200 plus $3,300 plus $12,000. That is $47,500. Now, I said at the start that I would explain what a deduction actually does, and this is the moment. That $47,500 is not money you receive. It is income that does not get taxed. What it is worth to you in actual dollars depends entirely on your tax bracket, and that is why I'm not going to put a savings figure on the screen. Anyone who tells you this deduction is worth a specific amount to you personally, without knowing your income, is guessing. Now, the new $6,000 deduction has conditions, and they're strict enough that you should check them properly rather than assume. First, you must be 65 or older by the last day of the tax year, not the day you file, the last day of the year itself. Second, if you're married, you must file jointly to claim it. If you file separately, you cannot. That is unusual, and it catches couples who have always filed apart for other reasons. Third, the Social Security number of each qualifying person has to be on the return. And fourth, and this is the big one, there's an income limit. The deduction begins to shrink once your modified adjusted gross income goes above $75,000 if you file single or $150,000 if you file jointly. Above those thresholds, it reduces by 6 cents for every dollar of income over the line. So it does not vanish the moment you cross it. It tapers off gradually. Before I move on, there are 3 confusions about this deduction that come up constantly, and each one costs somebody money. The first is people thinking it replaces the standard deduction. It does not. It is added on top. If someone tells you that you have to choose between them, they are wrong. The second is people assuming that because they do not owe any tax, it does not apply to them. That is understandable, but it is worth checking anyway, because a deduction that takes your taxable income to 0 can affect other things on the return. And the third, and this is the one I would most want you to hear, is people assuming they earn too much. The phase-out starts at $75,000 single, but it tapers at 6 cents in the dollar. That means a single filer with income well above $75,000 still keeps a meaningful part of the deduction. It only disappears entirely once you are a very long way past the threshold. So do not rule yourself out by looking at one number and deciding you are over the line. There are 2 more things worth knowing that do not fit neatly anywhere else. The first is that there is a separate additional standard deduction if you're legally blind, and it works the same way as the age one. If you're both over 65 and legally blind, you can claim both additions. The second is about timing, and it matters if you are close to one of those income thresholds. Because the new deduction only runs through 2028 under current law, and because it phases out on income, the amount of income you take in a given year can affect how much of it you keep. That is a genuine planning question, and it is exactly the sort of thing worth asking a tax professional about rather than working out from video. I am explaining the rules here. I am not in a position to tell you what to do with them. So what should you actually do with this? If you're 65 or older and you already use a tax preparer, ask them directly whether the new senior deduction was applied to your return. It began with tax year 2025, so if your last return was prepared without it, that is worth raising. If you prepare your own return, the deduction appears on the form itself, and the IRS publishes a short leaflet on it, Publication 6142, which you can read in about 2 minutes. And if your income sits anywhere near $75,000 single, $150,000 jointly, that is the point at which a conversation with a professional is genuinely worth the money, because the taper means small changes in income have a real effect on what you keep. One important note before you go. Everything in this video is general education, not tax advice. The figures I have quoted are for tax year 2026, and tax rules change. Please confirm your own position with a qualified tax professional or directly with the IRS before you act on anything. If this was useful, subscribing is how the next one finds you. And tell me in the comments whether you file single or jointly, because the numbers work out quite differently, and I would rather cover whichever situation most of you are actually in. Next time I'm looking at how Social Security benefits get taxed, which is the question I get asked more than any other. Thank you for watching, and I will see you then.